Are you ready to supercharge your wealth and unlock the power of passive income? Welcome to this episode of Dividend Discussion, where we embark on an enriching journey through the realm of dividend investing. Whether you're a seasoned pro or just starting out, this series is a gateway towards invaluable insights and firsthand experiences that will propel you towards financial independence. Join me as we dive deep into the minds of others in the dividend investing space that are eager to share their stories, mistakes, triumphs, and life-changing lessons. In each episode, we unlock the secrets of successful dividend investing, ensuring you can sidestep costly pitfalls and chart your own path towards financial freedom. Sit back, relax, and immerse yourself in this captivating episode of Dividend Discussion. Hello and welcome to another episode of Dividend Discussion here on Dividend Obsession. I'm your humble host, Troy, and today I have the pleasure of speaking with DividendBulls from Twitter. If you wouldn't mind, go ahead and telling the people a little bit about yourself.
Yeah, thanks for having me on, Troy. My name is Marcus. I go by DividendBulls online. I'm just a simple dividend growth investor from the Pacific Northwest, and I just a quick little blurb. I like to show that anyone with an average income can grow their dividend portfolio, and that's kind of what all my content's centered around. So, thanks for having me on the podcast.
Yeah, no problem. And I like that. I like that message too, because a lot of people think that, you have to have a $200,000 salary, or you have to, come from a lot of money or whatever. And you can really get started with, as little as $1. I know that sounds gimmicky, but that's true.
Yeah, and I know it's not always the sexy numbers that you might get used to, but it's a journey, and if you start with that mindset, then you'll be more patient,
Yeah,
and make better decisions in the long term.
yeah, I agree with that. Okay, so first question, springboarding off of that. So when did you begin investing specifically, and then what got you into the dividend side of investing? Because there's a whole bunch of other worlds out there you could have stumbled into.
Yeah, so actually, I graduated college in 2017, and so I started my first job, like big boy job or whatever you want to call it, right away. And so that's when I kind of started doing some options trading and just the typical penny stock stuff. And so after losing, about 200, $300 doing that, I figured, okay, I'm going to try to find some safe options here. And so, I really started harping on dividends in 2020. That's really kind of how I started my dividend growth journey. And so, yeah, then watching and consuming as much content as I can around dividend investing really helped me, grow to where I am right now.
That's really cool. So you are like probably 90% of most people I've interviewed where you don't start with dividend investing. Most people do start with whether it's penny stocks because you can buy a lot of stock for a little bit of money, or the options trading is actually like a new thing. Like I think the last couple people I've interviewed, they all started with options trading as well. So like, do you know what attracted you to that? Was it the you can buy a lot with a little bit of money, or was it like the quote unquote promise of making a lot of money really quick, or what got you into that?
Yeah, I mean, when you're starting off, you can't really afford to buy like a Broadcom where that's like $800 per share. So like an option, you can buy it for like in like $2 or $3, and then hopefully it might explode. And so that was the big hope was, okay, I can find something that's super cheap, and then it'll be like a lot more expensive when I sell it, and then I can profit off that. But long term, it's so risky, and that was the allure of it. But once you learn more about investing, and how the best investors are like Warren Buffett, they follow a dividend strategy as well, and you kind of take notes from them and try to emulate them as much as you can.
Yeah, it's like the thrill of the hunt too, because you're like you
Yeah,
see all these like newsletters and stuff where it's like, oh, this could be the next Tesla, and you're like, all right, well, I mean, it could, everything could, but it won't. So
yeah, and like those the get rich quick schemes
mhm.
are really enticing to
Yeah,
follow.
yeah, and that's that's not even just investing, that's just in general. So
Yeah.
okay, so speaking of that, so keeping this dividend specific, what is the biggest dividend related mistake you've made so far? I say so far. I mean, hopefully you don't make any more mistakes, but so far, what's the biggest one you made? And more importantly than the mistake you've made is what lesson did you learn from that mistake?
Yeah, that's an interesting question because I've kind of had a conundrum like within the past month or two, with the Medical Properties Trust. It's a REIT,
Mhm.
and
That's
they
MPW, right?
recently, yeah, and they
Yep.
recently slashed their dividend, and a lot of bad financial information came out about their tenants. And so I ended up selling my position with them at like a 60% loss on capital. Um, but again, that was a really high yielding one that I got into just because it's like, okay, well, I don't need to invest a lot of money to be getting dividends with this. So I'll just have a position of, a lower position in my portfolio and then just kind of sit on it and just collect those dividends and reallocate those dividends to another position. But yeah, I mean, in the future, ever since I got rid of that position, I've been looking at some more safer options, around like the 2% range, and that have like a substantially higher dividend growth rate over a longer term. So, yeah, I think MPW would be my most recent mistake. I don't typically have a lot of mistakes. It's more investing in a solid position and then just kind of not adding more to it until it gets to a certain price point, or I feel more comfortable adding more to it with like a more positive outlook or something like that.
Okay. Yeah, that's cool. So, I mean, it sounds like you, along with I think everybody that's ever done dividend investing, kind of fell for the yield trap of like, oh, I can put it's almost like the dividend version of a penny stock, right? Like you can put a little bit of money in it and gets you a lot in dividends in return.
Right.
But at the end of the day, like, I don't know. I'm from the Northeast, so we always used to say, like, when we would get like a big snowstorm, you could tell how long the snow was going to last based on the size of the snowflake that was coming down. So when it
Mm-hmm.
would snow and it was these ginormous snowflakes, you knew one day where it was like 40, 45 degrees, all that snow was going to go away, or most of it. Versus
Mm-hmm.
like the snowstorm that you get the same amount of snow, like say it's 18 inches per snowstorm. The snowstorm where it was coming down at a steady pace of like really small snowflakes over a long period of time, that snow never seemed to melt. And that's kind of the same with like building your portfolio. If you want to do it like slow and steady, it's going to be a more resilient portfolio, both the, downturns and dividend cuts, if there are any, and stuff like that, versus trying to build it with these big snowflakes all at the same time. There's not, you can't really mold your portfolio to how you want it to be when they're like when you're trying to build a house and you have to build it like, okay, here's one piece for the foundation, here's one roof, versus like they don't build a roof one piece at a like they build it one piece at a time, not one roof at a time, if that makes sense.
Yeah, exactly. And after that whole conundrum with MPW, I have been I've been trying to look for those, like what you said, like the smaller snowflake ones that stick around for a lot longer.
Yeah, I mean, what is your I mean, we'll probably get into this a little bit more, but like what's your timeline? Like how do you plan on living off of dividends eventually? Do you plan on just building it to a certain point and maybe having it as your vacation fund, or how do you plan on doing that?
Yeah, so I'm for kind of a perspective. I'm 30, and my wife is 28, and so we would like to be able to live off the dividends, and we don't make like a super high enough income that we like in order to replace that income, we wouldn't need a massive portfolio. So I mean, my timeline, I'm guessing around 50, a little under 50 to stop working entirely. And then that'll get us to 60 where we can start accessing our Roth and eventually taking Social Security benefits. But yeah, I would say another 20 years at the most, hopefully. We'll
Yeah.
see.
I mean, that's really cool because that's basically the same timeline I'm on. I'm 28. The wife is actually 30 for me, so we're a little flipped right there, which is
Oh,
pretty cool.
yeah.
So yeah, my goal is by 50. I want to retire off the dividends and stuff like that. So it's pretty cool. Yeah. So I mean, me and you both alike have tons of time to just let the dividend grow. I have a YouTube video out called "Yield Too Soon," and it's like the dangers of investing in dividend yield too soon.
Hmm.
And it basically just shows like, here's some of these very popular high yielding stocks. Here's what they can get you today. But that doesn't grow. If anything, sometimes it actually shrinks of when you actually need the money versus buying into something now that's way lower in dividends and letting that grow to the point where it's growing when you need it to grow, if that makes sense.
Yeah, definitely. And the one caveat I will say to that is something like an Altria,
Mm-hmm.
ticker MO, if for people out there that aren't sure of that. But they've been growing their dividend for a long time, and they have a pretty enormous yield as well.
Mm-hmm.
But they've found a formula that works, and so they just keep doing it. And so there are some out there that are solid enough positions that, and they're in a good financial state where they can sustain a dividend with a high yield. But yeah, those are very rare and a lot more risky than a more solid position.
Yeah, and then you when with stocks like that, you get into the some people don't want to own stocks like that because they're considered quote unquote sin stocks.
Yeah.
And then other people, I mean, some people are just wondering, like in 10 years, like I see a lot less people smoking now than I did 10 years ago. So like in 10 years from then, like what happened? So I don't know. It's one of those forecasting things, like you're saying. That is, Altria is one of the very few where their dividend growth rate and their yield are both high, which typically it's, one or the other. So that's a good point in pointing that one out. So
Mhm.
okay, so you've only been investing for about 3 years, same as me. So has your investing style changed since you started, and if so, how so?
I really don't think so. I've kept the same dividend growth strategy since I started in 2020. Some of the content that I watch is from a YouTube channel called Dividend Diplomats,
Mm-hmm.
and there's these two guys who talk about dividend stocks and talk about their portfolios and stuff. And so I kind of get ideas from them, and they go over some of the key metrics that they like the PE ratio and the payout ratio. And so I kind of take notes from them, and kind of, if they touch on a certain stock, I'll take a look and see if that fits in my portfolio. But yeah, it hasn't really changed. I've added positions here and there, and cut one or two, but nothing crazy. But I think as a dividend investor, there's a sentimentality to it where you're like, oh, I've held my positions in like essential utilities or whatever. It's not a sexy stock by any means, but I'm not letting go of that unless something drastic happens with them. So, and even if something bad happens, or they're not growing as much, like the harm in selling that position or just holding on to it, like there's not that much harm in it as long as they keep their dividends and they keep paying out their dividends. You just allocate your money towards a different position. You know what I mean?
Yeah, yeah, I agree with that. Okay, so I mean, we touched on this a little bit already, but do you have any short-term goals that you're hoping to accomplish, like maybe by the end of the year or maybe within the next 12 months? And then do you have any long-term goals? And like, what do those look like?
Now, are you talking about like dividends
Yeah, dividends
specific?
specifically. Yep.
Okay. Yeah. So I would like to be able to get to $1,000 per month by the time I'm 35. So 5 years away. Right now I'm at 4,100 for my forward dividends per year. But so yeah, that the $1,000 a month, that would be a pretty cool benchmark. I don't know if that's a similar thing to you, or how your kind of benchmarks line up, but
So is your 4,100 or so your current 4,100 or your $1,000, which would be 12,000 a year, is that including all of your accounts? Do you keep track of all of that, or is that just your taxable account?
that's just my taxable account. My,
Okay.
my Roth, I'm not doing any type of, my Roth is just super safe with ETFs.
Yeah,
That's
that's the same
yeah,
with me. Yeah, I mean, I
yeah.
track everything together. I think with all of my accounts, which I just started a new 401k with a new company. So my old 401k I rolled over into my Roth IRA, which is how my Roth had such a big bump at the beginning of the year.
Hmm.
I think total I'm up to, like, I don't know, high 17s or low 1800s, including all of my accounts. But my taxable account, which is the one I want to live off of, I think has a current projected income of like high 700s, low 800s. But my dividend yield is quite literal. I have 11 holdings. I think my yield for my portfolio is like 2%.
Oh wow.
Yeah, I'm
What's
I'm
your
really
what's your
low.
growth rate?
Yeah, my dividend growth rate for my whole portfolio, all 11 positions included, is 10% over the last 10 years.
Nice.
So like that's what I'm really focused on, because I just want the capital preservation and appreciation, and then I want my dividends to just keep compounding themselves. And then if I get to the point where I'm making, I don't know, $30,000-$40,000 by the time I need it in 22 years off of dividends, and my dividend portfolio's yield is still 2-3%, at that point I can transition into something that's paying me 6-7%. I can instantly double that.
Right.
So, and like, it's long-term capital gains tax at that point. So it's a lot different and stuff like that. So, I mean, I would work with a tax person at that point saying, okay, is it better to do all this at the right now? Or is it better to, do it over the course of years, or however that works? So, I personally, when I'm looking at stocks, we might get into this too. I don't look at yield when I buy stocks at all. I don't look at stock price when I buy stocks at all. Like, I identify stocks that I want based off of other criteria and metrics.
Hmm.
And then I buy them. And right now I'm not really in the add new stocks situation. I'm just in I like the 11 holdings I have. I think for 2024, I'm going to kind of adopt a active versus dormant position strategy where I kind of have like, hey, these are the stocks I really want to actively buy. They still meet the metrics that they did when I bought them. That's why I bought them. And I'm just going to keep building them. I'm not really going to care like how much they weigh in my portfolio because there's going to be a bunch of them. I mean, I don't know, probably 8 of the 11 I hold still fit my criteria. And then those 3 that don't, I'm not going to stop. Like, I'm not going to sell them because like some of the things I've taken away from these interviews is some of the people's biggest regret is selling stock. Just because like, yeah, you might sell, you might cut off some losses, like for in your case with MPW, but then there's also going to be ones that you sold just because like you were a little wishy-washy on it or whatever, and it was just going through a little rough period, and now it's great or whatever. So sometimes people sell before they should, kind of thing, like I did with Nvidia. But I think that's the strategy I'm going to do right there. But yeah, like I said, I'm to answer your question, I'm pretty close to 800. I think it's like high 700s, like 780 or something like that.
Nice.
But like I said, it's still my big thing is I have a dividend tracking spreadsheet that I made, and I'm just focused on the year over year growth numbers of the dividends received. So like that's the cool thing with dividend investing. Well, the pro and con of dividend investing is it takes forever. That's the con. The pro is there's so many different metrics that you can decide to focus your attention on, whether it's your PADI, your projected annual dividend income, whether it's your year over year growth when you get your little bar charts out and you're like, okay, well, last June I made this much and in this June I made this much. That's a 67% growth rate or whatever. Like you can focus on all kinds of different stuff to keep you motivated. So
yeah, and I'm a spreadsheet nerd just like you as well.
Yeah.
I've even considered like coming up with my spreadsheets and like letting people download it and stuff. But yeah, it's pretty crazy into the weeds you can get, especially when you're like this dedicated to a dividend strategy.
Yeah, I agree. Yeah, I have my tracker that I made like a blank version of. But then I make updates to mine because I see it I invest every day. Well, I mean during the weekday I invest every day. And I made a blank version, but then when I'm in my portfolio, which obviously isn't the blank version, I make like a little change here from something I learned in it because I'm in data analytics. That's the field I'm in. So like I learn little tricks about spreadsheets all the time. So I'll do that to my spreadsheet, but then I never remember to do it to the other one, and then it quickly becomes out of date. And I'm like, this is a pain in the butt. So, okay, so you might not have anything for this, but I'm going to ask it anyway. So, do you have any stocks that you regret selling, or any stocks that you want to brag about buying? Like maybe you identified something at a really low price, and now you bought it, and now it's worth a lot more.
I would say, I think the only one that comes to the top of my head is Aflac.
Okay.
My cost basis for that is $47.50.
Wow.
And so that's one that I got right before they had like a massive dividend increase. So I mean, that's the only one. All my other ones are pretty boring, not explosive growth by any means. And especially right now, a lot of mine are actually down a little bit with the recent downturn. But yeah, I don't know how many people, but I think that's just the nature of when I started is 2020. Everything was down a lot with the COVID and everything like that. So yeah, I don't know if you have a lot more than me. Even though you only have 11 positions, you might have a couple that you timed a little bit better.
Well, yeah. So I was actually just going to ask you about that. So my situation with when I started investing is like you said, I didn't start with dividend investing. Quite literally, how I started was on Robinhood. I got my free stock, which was SiriusXM, which is how I began dividend investing. Weirdly enough, but then all I did to find the stock I wanted to buy is I went on, I think Robinhood's changed around a lot since I've used it last, but there was a section where you could go and you could see like the biggest movers, like either up or down in a day. And I clicked on the biggest movers and I saw it was ARTC or something. It was Orthopedics, something holdings. It was some bio stock and it was up like 36%. And I was like, oh, well, clearly if it went up 36% today, it's going to go up more tomorrow. So that's how I determined what to buy. So point in bringing all that up is like, I started at a good time, but that's assuming I knew what I was doing when I started. So I didn't have like, if I would have had this mindset with these parameters and stuff like that, I would have cleaned house. But I started and I was just like, I don't know, SiriusXM, whatever that one is. Like I stumbled into AbbVie and ExxonMobil at a relatively early point in my investing journey. I still own both of them, and those are my two best performing stocks. Now the thing is, I lower my costs, or I technically increase my cost basis, lower my like profit every time because I buy those every day. Like I said, I don't care about stock price. My thing is, I need the stock price and the dividends to be high 22 years from now. Both of
Right.
those are good companies. I think they're going to be worth more in 22 years than they are today, so I just buy them today.
Hmm.
So, I mean, it's one of the ways I'm able to like take emotions out of my investments, which is a really big tip I have for everybody, is just like, if you can step back and like not get too attached to a company because, you know, your dad works there, or not get too attached to a company because it was your first stock you ever bought, or whatever it might be. The more you can like sit back and like actually understand why you bought the company, what you like about the company, where you think the company's going, stuff like that, the more benefit you're going to get out of that. So I think I answered the question.
Yeah, yeah, you
Okay.
did.
Okay. So next one. So do you have any dividend milestones or achievements that you're either close to achieving or you've already achieved? Since you have spreadsheets like I do, you can probably track all that stuff. And then what role do those play in helping keeping you motivated?
Yeah, so I think overall, I mean, it's obviously cool whenever you hit like a round number. So like if you're averaging $300 a month over the course of a year in dividends, like that's always a cool milestone to hit. For me, like I have one position, Arbor Realty Trust. That's my by far my highest yielding position, and I've recently hit $100 every quarter in dividends. So that's a cool milestone. But like that's a position where I wanted to get to that point, and now I can just let the compounding and reinvesting do it, like handle itself, and not have to add any more to it.
Mhm.
But yeah, I mean, I think other than like individual benchmarks for my positions, like I don't have like an overall, except for like $1,000 per per month or whatever.
Mhm.
But yeah.
Yeah,
um,
mine. I mean, really, I because I'm a spreadsheet nerd, like you said, is I almost find new things to track to make me have more milestones, if that makes sense. Because it is a long, like me and you are both going to be investing for the next 20 years. Like that's a long time. I've barely been alive that long, much less, you know, planning what I'm going to do 20 years from now. So like the hard part is like, so I recently in my monthly recap videos that I put out technically at the beginning of the next month, I just put out October's, and it took me, I think it was 397 days to hit my first $100 received in dividends, just in this like taxable account. And
mhm.
this most recent time, I think it took me 20 days to go to the next $100. And like that's the snowball, and that's what you get to see of like there's so much like, oh, I don't know if this is going to work. Is my yield too low? Am I not putting in enough? Am I putting in too much? Is this the right company? Like there's so many questions you can ask yourself because you have so long to think about it. But when you start tracking like these other things, again, it helps you take your mind off of it and realize that I am on the right track. Like the going from I think $900 to $1,000 in career dividends in this account took me I think 44 days, and then going from 1,000 to 1,100 took me 20 days. And I'm not expecting it to keep shrinking to the point where it's $100 extra per day. Eventually it will get there, but like it's just that trend of like keeping that time getting shorter and shorter and shorter to make each $100. So,
Yeah.
but yeah,
And that's a cool metric. I didn't even think about tracking those days.
yeah.
So you're giving me more ideas
Yeah,
to
there you go. Yeah,
to
yeah.
dive
It's
into.
super. Like it was super simple because I have like the on one of my tabs on the spreadsheet. It's just like, hey, I on this day I got this much dividends from this company. So like I'm able to do a pivot table on how much have I ever received from ExxonMobil? When was the first time I ever got paid from ExxonMobil? How many shares am I dripping from ExxonMobil? Like all kinds of stuff like that. And then you can just total it up and be like, oh, okay, it took me from, March 29th of 2020 to whatever, I don't know, that would be like May of 2021 to get my first $100 because I had like a bunch of holdings. Each of them had like fractions of a fraction of a share. So I was getting, 12 cents here, 13 cents here. And eventually that totaled up to $100 and so on and so forth. So it's pretty fun to track.
Yeah.
And then yours is going to go even faster than mine because you got some higher yielders in there. So
Yeah. I mean, hopefully they stay high yielding and
yeah.
they don't get slashed, but
Yeah, yeah. Okay, so so you have the same kind of goal I do and kind of pretty much the same timeline. So I mean, you might not be able to answer this because I can't answer it. How or when do you know, or will you know, when enough is enough? Because like you and I both know that the dividend compounding, the dividend snowball is real. So like you might get to the point where you're 50 years old, your portfolio is making you 70 grand a year in dividends. But if you wait one more year till you're 51 years old, you might make $82,000 a year in dividends. So like, are you dead set on that 50 timeline, or are you like, hey, I kind of want to wait maybe a year or two and get up to 100 grand, or like how are you going to handle that?
Yeah, that's a good question.
Yeah.
I think when I can currently, when I can replace my income and my wife's income, that would be a good stopping point. Because at the same time, the growth, like my portfolio is going to keep growing their dividends, hopefully, in, like 20 years from now or whatever. So every year that we get a raise and everything. But ultimately, I mean, that would be the dream. But if there's ever a time where, my wife and I, we might have different jobs at that point. If we're happy with our jobs and we don't feel like it's hard work, that we are slaving away and that we hate it, like it's all about life stuff. If we're happy with our lives at that point, we can just keep pushing it back until we're finally sick and tired of it. And then we're even better off because we're getting more in dividend income because of the growth, and we haven't touched that drip yet. So I think everyone's answer is a little different. I just think it comes down to lifestyle and how happy you are at that point. Right now, our jobs aren't like too stressful that we're like hating, and like every day is a miserable slog to get through. But eventually, there will come a time when that is the case, and that's kind of when we want to turn off the drip and start taking those dividends.
Yeah, I mean that's a really good way to think about it too, because like my idea for like retiring early isn't necessarily retiring early. It's just being like financially free, I want to call it.
Right.
To the point where like maybe I don't have a job that I want and I want to retire from that job at 50, but like I'm really big into fitness and I'm really big into, helping people with like powerlifting and stuff like that. So maybe I do, like maybe I'm just a part-time personal trainer at some big box gym. I don't care. I work, Tuesday through Thursday from 10 to 2, like just something like that. I don't care what I'm paid because I just want to do that. It's something I want to do. And that's kind of what you're saying, like whether it's you getting another job on the side or you just have a job that you really like and you can stay there a little longer because it gets no skin off your back kind of thing. So I like that.
Yeah, and I'm really big into. I'm sure you've heard about pickleball, but
Mhm.
I've been playing pickleball like essentially as a religion for the past 4 years, and so I would love to like have that be like take my existence essentially. And so, and again, like just because you're not working at a job like what you said doesn't mean that you don't, that like you're bored at home and you're not doing anything. You can always volunteer and do stuff to keep yourself busy. So
Mhm.
yeah, I mean, it's just like what you said, being free from having to have a job
Yep.
in order to live your lifestyle.
Yeah, I mean, you could be a pickleball, a little instructor on the side where somebody's paying, I don't know, $20 an hour just to teach something that you would have taught them for free anyway. So
Yeah, exactly.
yeah, that'd be pretty cool. Okay, so I'm curious to know this for you. So do you have any specific criteria that you use when selecting your dividend stocks? Then if so, like what is that?
Yeah, so I'm going to refer to dividend diplomats for that.
Okay.
So it's a payout ratio between 40 and 60. And again, payout ratios can change, you know, quarter to quarter when the earnings come in. But like a lower payout ratio, as long as it's low and there's a history of dividend growth there, and the company is willing to grow their dividends, that's what I'm happy to see. And then PE ratio, so that's the price to earnings ratio, which kind of values, okay, is this stock undervalued compared to the S&P 500, or is it overvalued or whatever? And the current the PE ratio for the S&P 500 is like mid 20s right now, last time I checked. And so anything below that, like that's something that I'm interested in, or I'm interested in adding to. And then obviously dividend growth rate, that's extremely important. How long have they been growing their dividends? You got some companies like Procter and Gamble that have been doing it for over 50 years. So having a history of that dividend growth, that's super important because it means that the company values that, and that returning to value to shareholders over like maybe cutting costs to make like a bunch of profit, that they're not going to really innovate that into coming out with a new product. Again, that's different if you're looking at Microsoft or Apple, where they're coming out with new tech and new stuff like that all the time. So yeah, and then the dividend yield, obviously, I don't want to buy like a Zim that has 100% dividend yield, but at the same time, I don't want to buy something currently where I'm at that it's like a 0.4%
Mm.
yield. I want something that's in between, 2 and 4, 2 and 6, like around that area, so that I can get some yield now while also increasing that dividend going forward.
Okay, so question for you on the PE ratio. So when the reason I don't use PE ratio is because I found that not only does each sector have a different PE ratio, but each industry within each sector has like a different goal PE ratio. And then certain stocks are always historically low, quote unquote low on the PE ratio scale. And then other stocks, like I know, for example, one of mine is Costco. Costco always trades higher than the S&P. It always trades higher than its sector and its other rivals or whatever you want to call them. It's always trading at that, but it always outperforms. So like,
Right.
how do you handle that situation where like, oh, okay, like 17 PE for this one, like it's lower than the S&P, but it's high for that company, but that company deserves it to be high. So how do you handle like all those like conflicting responses?
Yeah, and I understand that, but for me, the way I look at it is the PE ratio is just a component of my decision making when it comes to like adding to something. Right now, I'm happy with pretty much all of my positions, and so now the kind of way that I'm keeping consistent with my investing is if there's an ex dividend date coming up and it's a position that's a little bit down, but the financials still look good, then I'll add to that to capture that dividend, just to kind of keep myself consistent and spreading out my investments across my positions, because I have like 34 positions. So it's there are some that I've kind of blacklisted for now just because the price is so high, and I don't want to hire my cost basis like that currently. But yeah, and I completely agree that the P ratio should not be the sole thing that you are looking at when you're adding it, but in combination with the growth rate and the payout ratio as well.
Okay. Yeah, because I mean that's kind of what like I think most metrics, if you look at them in a vacuum by themselves, they're not like there aren't many metrics that are good enough to stand on their own, if that makes sense. Like you always
Mhm.
need like I only have 3 filters when I filter for a dividend stock, but like some people have 40 filters and that's great. They understand that. I was trying to be like, okay, I don't understand a lot of this stuff a lot of people talk about. What can I boil some of the stuff that they do talk about down to? One, make sure I understand it. Two, make sure I can follow it. And three, make it where I don't have to like pretend it's an Excel sheet. I don't want to have to go to every column and add some kind of filter. I want to be like, okay, how few filters can I add to this and still get a quality list of stock, if that makes sense.
Right. Yeah.
Yeah.
And again, when you're looking to add a new position, you do a little bit more research rather than, okay, I've already established that this position is a safe position. I like it. I'm going to add money to it. It's already in your portfolio, so you're already comfortable with owning it, which means you're probably comfortable like adding more to it
Mhm.
rather than finding a brand new position. Yeah.
Yeah. Yeah, I like that. Okay. So, I mean, we're kind of doing a good segue here too. So, with that being said, how important is diversification to you? And then what metrics do you use to make sure that you are diversified if that actually matters to you?
Yeah, it does. I'll just start this by saying I have no positions in the oil industry. I don't believe that that's the way forward. I think it's gonna take a while to switch to fully electric like vehicles and stuff, but it's coming, and it's coming rapidly. So I don't even have any oil companies, but there's not one industry that I have currently. I'm looking at my portfolio that's over 17%.
Okay.
So it's pretty spread out. I have what 10 sectors that my portfolio is made of. But yeah, so I don't know if I'm the outlier or if it's similar to you. And I know you only have 11 positions, but you might be like weighted a little bit more heavily in certain others, because there's just certain companies and certain industries that pay out a little bit safer stock and that grow their stock a lot more compared to others.
Yeah. I mean, for me, I have 11, like you said, 11 positions. I don't own anything in my taxable account for real estate. One, because I own a house. That's my real estate or my quote
Mhm.
unquote taxable account. And then two, I own VNQ, which is a real estate ETF from Vanguard. I own that in my Roth IRA, which is tax sheltered. So those are
Gotcha.
my real estate tactics. And then the other one I don't own in my taxable account is communication services. I just don't like any stocks there. Like I personally like to me, the diversification thing comes down to like, would I want to force myself, like pretend, I own Apple, I own Microsoft, I own Visa, Starbucks, stuff like that. So like pretend I have something that would be considered overweight in my Apple stock. Like pretend Apple's too much. Would I rather add more to Apple and become even more overweight? Now, granted, I don't think either one of us are adding, $10,000 at a time. So we're
No.
relatively small amounts of money. So would I rather add my little bit of money to Apple and continue to build a position that I do like? Maybe it's overweight. Or would I rather force myself to buy AT&T or Verizon just because I don't have anything in the communication services? Like, to me, that's the difference. And I just don't want to, like you said, you can build your portfolio however you want. Like some people say 17% in a sector is too high. And then other people are like,
Right.
oh, I don't want more than 5% in each stock. I don't have enough stocks to have less than 5%. And then like, I think I have 20% in information tech and I have 20% in, I think it's consumer discretionary, are the two I have 20% in. And then everything else is like 11% and then, whatever is in between. But yeah, for me, that's really what it was. I just, like you said, you can build it however you want. And I don't want to force myself to own the communication service. I just don't like the sector. But then real estate, I don't think it's beneficial to have in a taxable account just because it's like dividends are really cool how they're taxed if they're qualified. But then you get into non-qualified, then it's just taxed like you're working a day job anyway. So
Right. And so just real quick about communication services, just because that's just an interesting thing that you brought up. I know that AT&T and T and Verizon are like great examples of stocks that are not like growing. They've made terrible financial decisions with like DirecTV and Warner Brothers and all that stuff. But are you against it just because they haven't been, their capital hasn't been, their like stock price hasn't been going, and their dividend growth is a lot lower because you obviously value dividend growth over a lot of other things, and that their dividend yield's just too high, that's a little bit more risky for you? Like what's the drawback? Because AT&T and Verizon are still massive companies that have a ton of customers across the country. So yeah,
yeah.
I'm just curious to see what your thought of that is.
Yeah, no, I mean mine is like I said, it's the nice part about using the filters is I don't have to let my emotions creep into it with exactly what you said. Like I personally, I've switched over to AT&T. I used to be with T-Mobile and they didn't do anything wrong. We were just, the wife and I were combining finances and working on like how to reduce our bills. So we were like bouncing around and doing price shopping and stuff. So I'm with AT&T. I know a bunch of people that are with Verizon. They both have very good cell phone service, like all the things they're doing, good things here. I'm sure they're doing not so good things other places. For me, it was just like when I add those filters, that helps me take the emotion out of like, I know so many people with this, or I know that this company's still doing things or whatever. It was quite literally like one of my filters is a dividend streak of 5 or more years, which I think Verizon's still part of that, but AT&T's not because they just had to cut. So like
Yeah, that's right.
they're off the list just right there. So Verizon's still on, but then the next filter is outperforming the S&P 500 over the past 10 years, and Verizon doesn't fit that list either. So now Verizon and AT&T are gone, and then the final one is a 3, 5, or 10-year dividend growth rate. I prefer all three, but like that I'll settle for one or two of them of above 10%. So like neither one of them meet that metric. And like I said, I don't even look at yield. I don't look at yield and I don't look at stock price. So like if AT&T and Verizon happen to meet those qualifications, or that fact, any other communication services stock met those criteria, then I would look at them and I'd possibly add them. But it's just like real estate most of the time. So even when I do my Power 5 videos that come out on Fridays, everybody says, I'm against real estate or I'm against high yielding stocks and stuff like that. I do kind of the same filters for that Power 5 that I do with my own portfolio. As far as like, I don't want to give people stocks that are going to underperform the market. Cause to me, I don't know why you would invest in stocks that underperform the market. Cause it's easier just to own the market at that point. And like everybody's goal is to make the most amount of money. So like I would rather own S&P 500, keep it for 30 years. And then I can sell the S&P 500 and put it into ABR. Because now ABR actually does outperform the market, which is cool. Because like I think at one point their dividend yield was like 13%, or maybe it's like down to 11 or something right now.
Yeah, and their growth rate's crazy.
Yeah, their dividend growth rate's really good, and they outperform the market, which typically, like this is quite literally from stats that I look at all the time. The higher the dividend yield goes, the lower the dividend growth rate goes, and the more likely they are to underperform the market. So it's just quite literally like how my filters, like my toggles are set up. And maybe in
Hmm.
the future, like when I do need the money, beating the market's less of a worry for me, and I do need the yield. So maybe I lower beating the market, I take that one off, and now it's like, okay, I need a yield of 4% or higher or whatever. So I just change my filters as I go. But for now, if maybe in 20 years AT&T or Verizon are doing the things that I care about at that time, then I can add them at that point. But for now, they just don't meet my stuff. So
Gotcha. That makes sense.
yeah. Like I said, for me, one of the biggest thing is like looking at the number. I don't care about the emotion of it. I don't care what so and so owns or how. Oh, this person's rich and they own AT&T. That's great for them. I don't want anybody to be broke. So I want you to make all the money. I want me like that's the cool thing with investing is like when I invest in a company and you invest in a company. Like say we both bought Apple. If I make $1, you can also make $1. It's not like a job application where like if I get the job, you don't get the job. So like
Right.
I want you to make all the money. I want to make all the money. I want everybody to make all the money. So I don't like there's no like vendettas out for anybody. I want everybody to be successful. So I don't know how I got on that part, but anyway,
Yeah.
okay. So we're doing really good on this, by the way. So next one. This is kind of like a question that kind of stumps people. So I can give you some examples if you need it. But are there any dividend related myths or misconceptions that you hear all the time on the internet that you just want to like debunk and tell people that like it's not true and this is why?
Yeah, I think the one that stands out is you see people boasting about I added 40 shares of Altria today. It's like, wow, that's a lot of capital that you just expended on that. Like, first off, what are you doing to make that much money that you can expend that?
Yeah.
And secondly, are you doing this every day? How often are you making these huge purchases of shares? And so, and I think that's my big thing with kind of showcasing my journey is, my wife and I, we don't even make six figures combined. But if you lower your costs, you don't, and again, we don't have kids or anything. So like we don't have car loans, we don't have student loans. So it's a lot different for us. But if you can lower your costs in your daily life, that opens up a lot more financial opportunities for you to invest in your future and stuff like that. So I think the long story short, I think the big myth I hate hearing about is, oh, so and so is making $200,000 a year. No wonder why they have a huge dividend portfolio. It's like, yeah, I'm gonna get there one day, but I'm never gonna be making that much money. I don't think so.
Yeah.
Yeah.
Yeah, you and especially like that was one of the I made a video, I keep plugging the channel, but I made a video a long time ago about it was everybody thought it was clickbait, but it's actually not. The title was like why stock price doesn't matter or why I believe stock price doesn't matter. And the two reasons for that is one was because of fractional shares. And then the other one was because of dollar cost averaging. Like no matter if something's too high or too low, you can always continually buy little by little, and you can buy fractions of a share to get you to the point where in a month, like pretend it takes that person that you said bought 40 shares of Altria, pretend it takes them a quarter, like maybe every quarter they buy 40 shares of Altria, or that's when they can spend all their money. You can do the same thing by adding little bits of shares over the course of 3 months to get to the same end result. And your result might end up being better than theirs because you were buying all the way during ups and downs and all the peaks and valleys. You were buying that whole time
Right.
versus maybe Ultra just had a 10% run up and it's the end of the quarter. It's time for them to make their buy. And now they're buying it at the top. So I mean, I agree with what you're saying is you don't have to, take big bites of the whole thing. You can do little bites at a time and you can get exactly where you need to be, whether you're making $1 million a year or $50,000 a year. You can do the same thing. It just, takes different amounts of time for different people.
Yeah, and everyone's journey is different too.
Yeah.
Some people might be happy with having, their end goal being like $3,000 or $4,000 per month in dividends, and then being able to live off that. But some people are like, well, I can't. I need 8 or 9,000. So it's just everyone's a little bit different, and just realizing that we're all starting at different spots, and we're going to end at different spots as well.
Yeah. Yeah. And at the end of the day, some people's goal isn't to live off a dividend. Some people just want to have the drip end up funding a travel account for them so they can go on trips. Or
Yep.
maybe it's like, oh, I want, like I'm a big Thunder fan. So like we get season tickets for the Thunder. Now we get like the nosebleed seats. I just want to be there. I don't really care
Right.
where I sit. So like maybe my goal, like if I didn't want to retire off of dividends, is like every year I want my dividend portfolio to pay for my season tickets. And like as that grows, I can get better and better season tickets because my dividend portfolio is paying for it. So
Mhm.
you could do something like that. And at that point, like you don't need that much money in your portfolio and you don't need to invest for that long to accomplish something like that. So it's all, the finish line's different for everybody and the starting line's different for everybody too. So
Yeah, exactly.
yeah, I like that. Okay. So we are making record time, by the way. So my last question for you is somebody's watching today's interview and they decided that because of what you said or because of what I said, that they're not only going to start investing on Monday, but they're actually going to start dividend investing on Monday. So you can't use the standard just get started. What other tips would you have for them now that they're going to start their dividend journey?
That's tough because I feel like we've touched on the very important things already. That I don't have any secrets, secret metrics that I look at or anything like that. It's just finding high quality companies to invest in that have been around forever and that have increased. They have a long track record of increasing their dividends because those are the ones that value their value that they're giving back to their shareholders, and those are the ones that are going to continue doing that because that's why people invest in them to begin with. And so it's that combined with don't try and get rich quick. Don't be buying Zim or any super high yielding positions because patience is key with this. This is ultimately a long-term strategy. You will not be getting rich quick with this. So any notion that you have of that and you want to do that, go do options trading or something and then learn that that's not the way. It's just being able to be happy with where you are right now and not trying to do too much to where you're accepting a large amount of risk with hardly any return and just because this at the end of the day, this is your money that you're making from a job or something like that, or maybe you've saved up a lot or you've inherited a lot. You want to take care of that money and protect it. You don't want to be making stupid financial decisions. So yeah, I would say to start off with, if you're starting on Monday, find some super solid companies that you want to invest in. And if you don't want to start like that, it might be a little bit too scary to find those options of dividend growth positions. Just invest in the S&P 500 doing some type of ETF because that's always the safer option. You get a little piece of a huge pie of hundreds of companies around the world. So yeah, I don't know if that's too long of a checklist or whatnot, but
No,
yeah.
no, I like everything you said. Like that's always my suggestion too. Is like if you get to see this video and maybe you don't invest at all, maybe you don't even have a 401k or you don't have anything like that. Like just getting started with an ETF, that can be enough to one pretend you never get an interest in dividend investing or investing in general. Just have constant amounts of money going into that ETF, the VOO or whatever it might be over time, that's going to be beneficial to you, even if you never gain an interest to it. But there are like the VOO pays a dividend. So maybe you're in there and you're like, oh, okay, like VOO is doing really good. I see how my money is growing over long periods of time. That's pretty cool. Like, I wonder what makes up VOO. And then you can start looking into that and you're like, oh, okay, Apple's in there, Microsoft's in there, Visa's in there, ExxonMobil's in there. Like all these different companies are in there. We're like, what can I own those companies by themselves? And oh, these pay dividends. Like that's pretty cool. And then like you can start getting into that path. Like I said, that's the wormhole you can go down into expanding your preference or your like how much you like dividend investing or investing in general. But like I said, worst case scenario, you never gain an interest in it, but you're still growing your wealth for, generations to come by, the passive hands-off approach of, ETFs. But me and you both agree, dividend investing is wonderful too. Cause like whether I'm sick on a day or whether it's the best day ever, the worst day ever, like I'm still going to get that dividend that's supposed to come in on Tuesday. Like there's nothing that beats that. Like you're just going to randomly get paid. And then what happens when you randomly get an email and so is giving you a 10% dividend raise? You're like, I didn't even have to go into the boss's office and get worried that I'm going to get fired. Like they're telling me I'm getting a 10% raise for a company I don't even work for. Like what beats that?
Right. And I think, we're relatively new to this. I've only been doing this for 3 years, and every time I get a dividend that hits my account and that gets reinvested, I get a rush of dopamine.
Mm-hmm.
So like what, like it's such a great feeling knowing that your holdings in a company or an ETF or something, you are, like what you just said, you're getting paid for not doing anything. You're just holding, and you're just sitting back and letting the money come in. So
Yeah. I
yeah.
mean, I think it's Warren Buffett's quote that says, if you don't find a way to make money while you're sleeping, you're going to work until you die. So,
Yeah.
I mean, you just really like quite literally, like I think it was Tuesday or Wednesday of last week, I got my Illinois Toolworks dividend of like $18. And I was showing it to my little baby son. He's 9 months old. He doesn't even know what I'm talking about. But I showed it to him. I was like, look, buddy, we made $18.34 today. He goes, like he just looking at me like, I don't know what you're talking about. So, but it's just cool. Like I literally did nothing, was just chilling, at a doctor's appointment or whatever. It was actually at his doctor's appointment, was just chilling there. And I got $18 added to my account. Like I didn't like, if somebody's just walking down the street and wants to hand you an envelope worth of $18.34, you're going to say no? Like I'm not.
Right.
So,
And yeah, I like you telling your son, I tell my wife every time we get a dividend, and she's like, okay, so can we retire yet? Like, no,
yeah.
no.
Are we there yet?
Yeah, you're gonna be asking that question for a while, but
Yeah. I mean, it's gonna be really cool. Like one of those days she's gonna, ask you, maybe she, gets more of an interest in it as she sees your excitement level start, like, continue to grow with it, or like she knows, hey, you said when we're 50, like we're getting close kind of thing. But like even if that doesn't happen, like one day she's just gonna ask you that question. You're gonna be waiting for the question, and then she's gonna say, hey, can we retire yet? You're like, yeah, we can. And she's like, wait, like that's not the answer you
yeah.
gave me for the last 20 years. Like, are you playing with me? Like, what's going on? So that'll be
Right.
pretty cool. But yeah, anyway, man, I appreciate you for setting I don't know if it's a record time, but you killed it with this, the timing thing that we spoke about earlier. So way to go for that. I appreciate you taking time out of your Sunday to speak with me. And if you have anywhere where people can find you and follow along with your journey, go ahead and feel free to plug that.
Yeah. I don't have fluff. I don't want to waste time. So yep.
Yeah, I like it.
Yeah. So my Twitter or X or whatever is Dividend Bulls with an S on the end. No, I do not have a YouTube channel. That is some other person. I'm not that person.
That's somebody else
I,
that stole your name before you could get it.
Right. Yep.
Yeah.
And then, so I also have a newsletter on Substack. It's called Running with the Bulls, and I show kind of my journey. It's a monthly newsletter. I want to get that to weekly at some point, but for now, I'm just sharing my portfolio and my additions to the portfolio, how much dividends I received every month. So if you're interested in what that journey looks like, you can go ahead and check that out. That link is in my my Twitter profile as well. So yeah, thanks for having me on, Troy. That's all I got for any plugs or anything.
Cool. Yeah. And I'll make sure all that stuff's linked in the description down below the video. So there's a lot of stuff down there. So just scroll down there, find all his links for his Twitter or X or whatever we're calling it now, as well as his Substack. Make sure you guys give him a follow and follow along with his journey. And that concludes another insightful episode of Dividend Discussion. I hope you found inspiration and valuable takeaways from our engaging conversation. If you're hungry for more dividend investing wisdom, be sure to subscribe to Dividend Obsession and hit that notification bell to stay up to date with my latest interviews, tips, and strategies. Remember, the journey to financial independence is a marathon, not a sprint. Keep applying the lessons you've learned and stay committed to growing your wealth using dividends. Together, we can create a community of dividend investors sharing knowledge and supporting one another. If you enjoyed this episode, don't hesitate to share it with other investors that are equally passionate about the power of dividends. Let's spread our dividend obsession far and wide. But until next time, see ya.